Extended lockdown to combat COVID-19 is costing businesses dearly. Majority of companies are facing cash flow constraints during the current disruption. Let's do a three-point analysis to understand which are the sectors that investors must avoid as they may be facing the maximum amount of heat. 1. Chemicals and agrochemicals. Well, the Indian chemical companies have been operating under multiple levers. Now, if you see broadly, there is one set of companies that were positioned for strong domestic demand, and they were also capitalizing on trend towards import substitution. Now, another set of companies were benefiting from a trend towards India emerging as an alternate supply chain partner for global MNCs. Now, when we consider these two scenarios, the debt to equity ratio at the aggregate level for the Indian chemical sector as a whole is slightly higher at 0.7 times. Now, when we look at a plausible scenario of sales volume degrowth of 25%, also an additional 10% lower sales revenue due to the lower product prices, and interest coverage ratio drops from 5.5 times to a mere 1.9 times. About 48% of the chemical companies would have interest coverage ratio of less than 1.5 times, which raises the risk of default for a large universe. Now, given this situation, we advise investors to avoid Deepak Fertilizers, Goa Carbon, Ineos Styrolution, Vikas Ecotech, Camlin Fine, and also BASF India. 2. Steel and non-ferrous metals. Well, companies such as Tata Steel, JSW Steel, SAIL and Jindal Steel, also Jindal Steel and Power, they control about 60 to 65% of the domestic production. Now, as on 30th of September, all the major companies had a debt to equity ratio of about 1 times to 1.5 times and the interest cost coverage ratio of about 2.2 times. For FY21, we have assumed a degrowth of around 15%, lower realization by 10%, and lower EBITDA per ton by 22%. If this scenario plays out, then the interest coverage may drop to around 0.9 times. Now, other aspect which investors can notice that Tata Steel has a large presence in the European region through Chorus, while JSW Steel has presence in US and Italy. Investors need to be watchful of this sector and should not jump in early. Overall, names which should be avoided due to stretched balance sheets are SAIL and JSPL. Now, in the non-ferrous space, given the lockdown in the US and Europe as well, Novelis's earnings can get affected. As 64% of Hindalco's revenues come from Novelis, this is an important factor to track as well. Now, majority of Vedanta's earnings are supported by Hindustan Zinc. Now, the slump in zinc prices are likely to have an impact on Hindustan Zinc and in turn on Vedanta as well. In the non-ferrous space, investors must avoid Vedanta due to the weak balance sheet as well. 3. Oil and gas. Globally, oil markets have seen a sharp downtick owing to sliding demand due to the COVID-19 outbreak and the non-cooperation between the OPEC plus nations. Now, the global economic slowdown could further result in a demand dip. Upstream oil and gas producers are expected to take a substantial amount of hit. For downstream companies, lower crude prices mean lower cost of procurement and are positive for marketing margins. However, the lower demand is expected to have a larger impact on the throughput at refineries, which will definitely impact the gross refining margins going forward. Now, major oil producers and oil marketing companies have a substantial debt in their balance sheets, with the debt equity in the range of 0.3 times to 1.1 times. Now, under stressed conditions, we see that IOC and BPCL would be more vulnerable and therefore could be avoided. Now, companies that are focused on the domestic household gas businesses, they will be definitely better off.